Hi everyone. Thanks for joining in on a Sunday morning. It's fairly cloudy and cold here in Bangalore. Hope things are fine on your end. So today, along with our rebalance updates, we are going to be discussing the potential of small cap focused stock portfolios as well. Given what has been happening in the market and how small caps have run up, we thought it's very pertinent that we have a discussion, a candid discussion around how small caps work, what are the risks involved, where they should be part of your portfolio, and what are the specific offerings that Windmill Capital has. So, without much ado, let's get started. Okay, so what we're going to be covering during today's presentation is one, the idea of a small cap premium. What exactly is a small cap premium? Why do a lot of investment managers or a lot of industry participants keep talking about this, investing in small caps, why it is necessary to get an exposure to small caps and all of those things. Next, we will have a quick look at what has the small cap performance been over the long term in India and how they react during extreme situations. Then we'll jump on to small cap focus, small cases offered by Windmill Capital and what's their performance been like and stuff like that. Finally, we will do a quick review of whatever were the December 2023 rebalance updates. You must have all received the rebalance updates for now, and you should have seen what are the changes that we have made in specific small cases. And then finally, we can open the floor for any questions that you might have. So let's just get started. Idea of small cap. So what exactly are small caps? As per SEBI definition, small cap companies are those whose market capitalization is greater than 250. Any company whose average market capitalization over the previous 6 months, what SEBI does is it makes a list of all companies listed on BSE and NSE. Then it calculates the average market capitalization over the previous 6 months for these companies, and then it ranks it on the basis of this market capitalization. So any company that has a market capitalization rank greater than 250, all of those companies are going to be marked as small cap companies. So the question is why, a lot of investment managers talk about investing in small caps, and what is the special deal about these small cap companies? Let's take one step behind that and start our discussion with factor investing, and then we will move on to small cap size premium, and then how where small cap fits into the entire equation. Now, factor investing is essentially exposing your portfolio to one factor that has historically, has been a persistent driver of stock returns. So let me simplify the entire thing with an example. Everybody talks about investing in companies that have a low PE ratio, right? So valuation is a factor. Similarly, everybody talks about investing in growth companies that have been growing their revenues and earnings per share at a fairly fast clip while maintaining their margins. So growth is a factor. Very similarly, one another most important factor is the size premium. So what does the size premium factor explain? It suggests that small cap companies provide greater, on an average, historically, small cap companies have always provided greater returns compared to their large cap peers. And this phenomenon of size premium, academicians have observed it across time periods and across geographical locations. So it is not just in India that this size premium exists. It exists in developed markets like USA, Japan, and large parts of the European Union as well. So people have sort of dug it up, they have explored it, and they have realized that over long periods of time, on an average, small cap companies provide greater returns compared to large cap ones. So now that we've understood what is size premium, let's attempt to understand why this happens. Why do small cap companies provide greater returns compared to large cap ones? Intuitively, one should understand that the bigger you are, you should be able to, perform better. But how is it that, the opposite is happening? That even though you are a bigger player, some small sized company is able to provide better stock market returns compared to you. So what exactly is happening over there? So one way of looking at it is there are a couple of distinct factors that sort of drives this size premium. One is the market efficiency. Now, to explain that in simple words, there is a lot of information available about large cap companies, right? Journalists are covering these companies on a daily basis. Brokerages are covering these companies on a daily basis. The company itself has dedicated teams, investor relation teams, sophisticated investor relation teams to sort of reach out to broker community, journalists, and any other stock market enthusiasts to talk about their, plans, talk about their performance during specific time periods, explain what is it that they are going to do, and all of these things. Now, what happens with small cap companies is they usually don't have the budget for all of these things. Their investor relations team will not be very sophisticated. There will not be a lot of brokerages and journalists covering these companies, which is it. Because of that, what happens is there is a lot of information asymmetry. There is not a lot of information available, about these companies, which is why price performance of these companies will not be very efficient. They will not immediately react to any development that might have happened in the company because not a lot of people are tracking that company, right? That is one of the factors that explains size premium. The second factor that explains size premium is the growth potential. Now, if you're a smaller company, to grow from 1,000 to 2,000 is fairly easy, right? But try doing the same thing when you have a sales of 1 lakh rupees. Growing from 1 lakh rupees to 2 lakh rupees is extremely difficult. So, and what happens with stock markets is stock markets are always rewarding you for any growth that you might display, right? So growing from 1,000 to 2,000 is easy. That gets recorded as 100% growth, and stock market rewards you accordingly. But growing for 100,000 or 1 lakh to 2 lakh is very, very difficult, which is why stock market does not reward you accordingly for the growth that you might be, displaying. You might be doing well for a large cap company, no doubt about it. But when compared to small cap companies, the growth potential, the future growth potential of large cap companies are on the lower side, right? Which is why stock market tends to reward small cap companies for their future growth potential better than they do their large cap peers. Now, third instance, what is the third factor that probably drives the small cap, drives the size premium is the investor behavior. Now, because first there is a lot of market inefficiency, right? There are not too many journalists or brokerages covering these companies, which is why, not a whole lot of information about specific companies are available in the market. Second, there is growth potential, but at the same time, what happens with small cap companies is they don't have the best of the leadership teams, or their business models are not as defined as that of their large cap peers, because of which 1 or 2 bad quarters and the stock prices gets pulled down, or there is a lot of fear about what is going to happen to the future growth potential if there are extreme movements in the market. All of this sort of results in an investor behavior where there is a lot of fear and skepticism about the performance of these stocks. So one bad quarter, you might not think too much about that in case of a large cap stock. But 1 or 2 bad quarters, you might be, investors tend to get spooked when it comes to small cap stocks, and they tend to dump it in the market, which is why there is extreme volatility in price performance. All of these factors sort of come together to create a size premium, which is why some of the best small cap companies on an average provide greater returns compared to their larger cap peers. Okay. So I hope, my explanation suffices. We've discovered what is factor investing. We have understood, I've explained to you with example what is like a factor. You can think about PE ratio as a valuation factor. You can think about growth of revenue and earnings per share as a growth factor. Very similarly, investing in small cap comes under the size premium factor. And I have told you why this size premium has come about. It is very important to understand that. So now let's move on. What has happened to historically, what has been the performance of small cap stocks when compared to their larger cap peers? So I pulled out the performance of Nifty 100 and Nifty Small Cap 100 since November 2006, and you can see those extreme volatile periods of Nifty Small Cap 100 compared to Nifty 100. You can see that in October 2008 to 2009, when the stock market starts recovering post the global financial crisis back then, the Nifty Small Cap 100 had fallen much more than Nifty 100, but the recovery was also much steeper. You can see that this line on 1st April 2010, it is at a much higher level when compared to Nifty 100. Very similarly, you can see that post elections in 2013 and 2014, the small cap stocks ran up significantly higher when compared to their Nifty 100 peers, right? Very similarly, if you look at the correction during 2018-19 and subsequently during the COVID crisis and stuff like that, the correction was also much, much steeper. Whereas Nifty 100 for long periods of time gave, sort of like, slightly negative or even flattish returns during 2018-19 and then during 2020. Nifty small cap 100 had like a massive drawdown over there. Same thing happened during the COVID crisis also. But when the markets picked up, the Nifty small cap 100 picked up substantially higher. And even now, like, if you're talking about the current period, you can see that in December also that divergence in performance, whereas Nifty 100 has performed well, but the outperformance of Nifty small cap 100 compared to Nifty 100, you can see that yawning gap over there, right? So that sort of should be a good illustration of what happens during extreme conditions. I'll dig a little deeper into what happens during extreme conditions and how Nifty 100 reacts to extreme situations versus Nifty small cap 100. But this should be a good starting point for us. Now, I have simply told you that it is a lot more volatile. Let's look at the numbers. Now you can see that I have pulled out the rolling annualized volatility for Nifty 100 as well as for Nifty small cap 100. And you can see that for large parts between December 2014, right, approximately 2014 till 2020, which is like close to 6 years, Nifty small cap 100 was significantly more volatile compared to Nifty 100 stocks. Comparatively, even now, if you are looking at the performance of these two indices, you can see that since 2020 at least, right, Nifty small cap 100 has been significantly more volatile. It's come down. The volatility has come down recently, but it's still been significantly more volatile compared to Nifty 100 stocks. All right. So this is what you can sort of expect when it comes to performance and volatility of Nifty small cap stocks versus Nifty 100 stocks. Now, let's take a quick look at what happens during market downtrends. Now, in the previous charts, I told you that, Nifty small cap corrects a lot more. I'll illustrate that with few numbers. During market downtrend, the first instance that we can capture is global financial crisis, which was approximate dates were between December 2007 till July 2009 for a period of about 560 days. Now, you can see that Nifty 100 during that time period corrected by 36%, right? It was down 36%, but the Nifty small cap 100 dropped down close to 60%. Once again, during Greek debt crisis, which was between February 2011 and August 2012, time period about 531 days, Nifty 100, flattish performance. Nifty small cap 100, flattish, but still negative. COVID-19 crisis, January 2020 to July 2020, approximately 184 days, that's half a year. And you can see that Nifty 100 was down about 12.5%, but Nifty small cap 100 dropped down by 22%. Russia-Ukraine crisis, which is like, which is sort of like the crisis still continues, but the markets, at least the Indian markets, have stopped reacting to that for now. Between Feb 2022 and March 2023, Nifty 100, flattish performance, negative 4.3%, but Nifty small cap 100, negative 18%, right? So you can see that during times of extreme situations, the Nifty small cap 100 drops down significantly when compared to its large cap peers. Now, on the contrary, what happens to performance during market uptrends? Now, let's take a look at that. The first one, initially we discussed the global financial crisis. Now, let's take a look at what happened during the recovery after global financial crisis. Between August 2009 and November 2010, Nifty 100 returns was 37%, Nifty small cap 100, 54%. US Fed's QE program, September 2012 till May 2015, very long uptrend for 982 days. Nifty 100, 61%, Nifty small cap 100, 67%. Government reforms and global economic growth between 2016 and 2018 was a slight aberration. You can see that Nifty 100 actually performed better than Nifty small cap 100. But once again, let's take a look at what happened to performance during post-COVID pickup, which is like, very recent memory for us. Nifty 100 jumped up between August 2020 and Jan 2022. Nifty 100 jumped up by 56.7%, whereas Nifty Small Cap 100 almost doubled, 101% returns. Now, what has happened to the India growth story? That is the recent bull run that we have been seeing. Now, in the previous slide, I showed you what the Ukraine-Russia crisis between Feb 2022 and March 2023. Subsequently, since March 2023, we've started seeing markets have, at least in India, markets have started picking up, right? So till December 2023, for a period of 260 days, Nifty 100 has given 25.6% returns, whereas Nifty Small Cap 100 has given 68% returns. Right, so you can see the stark difference between during both uptrends and downtrends. Just to recap, during downtrends, Nifty Small Cap 100 drops sharply, but during uptrends, Nifty Small Cap 100 recovers extremely sharply when compared to Nifty 100 stocks. Nifty 100 is the large cap universe. Nifty Small Cap 100 is the representation of the small cap universe. Okay. Now, let's take a quick look at what has been happening so far over the last, since February 22 till December 2023. What exactly has been happening in the market? So the Russia-Ukraine crisis, I'll not get into the politics of it, but the Russia-Ukraine crisis kicked off sometime in October 2021, and there were clear hostilities breaking out in January 2022, and the market started trending down because of all of this crisis, because of America's involvement on one side and Russia's on the other, which are the biggest global powers. The market started taking a hit. So between February 22 till March 2023, you can see the performance. Nifty was down, Nifty 100 was flattish, negative 4.3%, and Nifty Small Cap 100 was down 18%. And during this period, a lot of you sort of even the performance, our small cap portfolios also sort of tanked. And a lot of you were understandably frustrated about it. You wrote into us asking why this is happening, performance has not picked up for my portfolio and all of those things. And we put out a lot of literature in our newsletters as well as via personal mails. I personally put out a lot of literature attempting to explain what exactly was happening to the universe of small cap stocks, which is why specific small cases like the value and momentum can slimmest, why their performance was suffering. Now, subsequently, after March 2023, till December 2023, the Indian markets have started to pick up. There are multiple factors contributing to it. One is India remains one of the large, one of the few large economies that are expected to grow at a fast pace. And this growth, we've sort of started seeing it. There is also probably certain expectations around elections next year. Once again, without getting into the politics of it, it seems like there is the Modi government is sort of expected to come to power, and whatever we've election performance the party has displayed in the recent state level elections, I think that sort of has also given a certain boost to market sentiments. So all of these factors have started coming together, and the performance of mostly all of the large, mid, and small cap stocks have started picking up from them. So the Nifty 100 has surged up by about 25% since March 2023. During the same time, Nifty Small Cap 100 has surged up by 68%. Now, once something like this happens, the most obvious questions anybody is going to ask and should be asking is, the market has already run up by 68%. Is this a good time to get into, either small cap stocks or large cap stocks, or what is the deal? Explain that to me. Convince me about it. Now, the obvious way of looking at it is not just based on performance, because I have shown you between February 22 to March 2023, if you take into consideration the negative 18% and this 68%, the Nifty Small Cap 100 has gone up by about 50% net, right? Very similarly, Nifty 100 has gone up during that time period. The Nifty 100 has gone up by about 21% net, right? The question is it worth my while? One easiest way of looking at it is from a perspective of valuation. What is happening to valuations? Your stock might have risen up, but you might be extremely undervalued. And then if your stock price rises up, it's a good thing. The PE ratio is expanding. There's nothing bad about it, right? So if you look at the first column here, talks about the current PE ratio of both these indices, which is Nifty 100 and Nifty Small Cap 100. And this column talks about the historical average. I've gotten this historical average data from NSE that's based on consolidated EPS numbers. So you can see that the current PE ratio of Nifty 100 universe is about 22.9, whereas the historical 10 since January 2010, which is close to 13 years, 14 years of historical average is about 22.5. So we are not, as far as large cap companies are concerned, we are not in the overvalued territory. Very similarly, Nifty Small Cap 100, the current PE ratio is about 27.7 and the historical average is 26.4. So there is a minor sort of like overvaluation, but nothing for us to be alarmed about. So I hope that clarifies to us about like, how small cap companies perform during extreme situations. And as far as the current situation is concerned, what has the run up been and what is the justification I can still offer to you for, investing in small cap stocks. So now that we have covered all of this, the next we have to cover the most important question. Where do these small cap stocks or small cap, curated baskets of either Windmill Capital or anybody else for that matter, where does it sit in my portfolio? Should I liquidate all my large cap holdings and move into small cap stocks? What should my allocation be in small cap stocks? These are some important questions that we need to answer. And before jumping on to where it should be sitting, I'll take a quick minute to talk about something called core and satellite investing, which is something that you should already you should have applied to your investments. The first aspect of core and satellite investing is obviously the core portfolio, this light blue, pink section that you're seeing. So what should your core portfolio have? It should have stable and diversified instruments. What is an example of stable and diversified instruments? An easiest way of building your core is by investing in ETFs, right? And if I have to take the example of Windmill Capital's offerings, I can think about all-weather investing. All-weather investing small case consists of ETFs, and it consists of a diversified basket of ETFs. The all-weather investing small case gives you access to large cap stocks. It gives you access to gold as well as gives you access to debt instruments, right? So we have 3 different asset classes as part of a single small case. And what is the point of using these ETFs? You're using the ETFs just to track market returns. And here we are talking about markets, not just in terms of equity markets, but market of all asset classes, right? The core portfolio should always just be tracking market returns. It shouldn't have to generate extraordinary returns for you. So the whole idea behind core portfolio is that, it is designed to provide stable long-term returns. And these stable long-term returns should work under all types of market conditions, right? That is what your core portfolio should be. Then on top of the core portfolio, you will have to build your satellite portfolio. Now, the satellite portfolio should have specialized or focused instruments. One example of a specialized or focused instrument is a basket of small cap stocks. Now, the reason why you are including this basket of small cap stocks is so that there is potential for higher returns, right? Like I told you, small cap stocks tend to have the potential for higher returns, but they also tend to be slightly riskier. You have to keep that in mind, right? And the whole idea of getting this satellite portfolio on top of your core portfolio is to ensure that the overall portfolio returns increases, right? So now your question might be, boss, I have 100 rupees to invest, let's say. What should be my core portfolio? How much should I invest in my satellite portfolio? Depends on your risk appetite, depends on your age, depends on your commitments, depends on how much money you can sort of generate in the future. I'll give you an example. Let's assume you are a 35-year-old and you don't have any substantial commitments. You just have to run your earn money for your family, and then there are no EMIs. Probably there is one small car EMI that you are paying. Then in such a situation, what you can have is, out of 100 rupees that you have ready for investments, probably 20 to 25 rupees out of that could be in your core portfolio. Rest of the 75 rupees could be in a satellite portfolio, right? What exactly is the breakup of the satellite portfolio? What exactly is the breakup of the core portfolio? Please reach out to an investment advisor. It has to be customized based on your situation, and I cannot tell it to you simply on a Zoom call where we are discussing small cap stocks. I cannot simply tell you this is what it should be. There are no thumb rules associated with it. It has to be based on your personal situation, the kind of commitments you have, how big is your family, are you responsible for your parents as well as your children, and whether your wife is working or not working, what is the amount of EMIs that you have to pay. All of these factors have to be taken into consideration before deciding on what should be the size of your core portfolio, what should be the size of your satellite portfolio, and what should what specialized or focused investments should be a part of your satellite portfolio. But general idea, just to recap, core portfolio, stable and diversified investments. This is to ensure that your portfolio, that at least a part of your portfolio is able to track long-term returns that is ideal for all market conditions, satellite portfolio, specialized or focused investments. This is going to be slightly riskier, but there is also potential for higher returns. And this should be used to enhance the overall portfolio returns. So I hope that clarifies as to how you can make small cap stocks a part of your portfolio. Now let's quickly move on to what are the small cap focused small cases that Windmill Capital offers, right? One of the first ones that we have a small cap focused small case is the quality small cap smart beta. This essentially gives out, or this consists of quality small cap stocks. Now, the word quality is extremely important here. Not all small cap stocks are built equally, right? Just like not all large cap stocks are built equally. There has to be a quality associated with a small cap stock. So how do you define quality? Windmill Capital has designed its own proprietary, sort of a ranking criteria to rank all small cap stocks, and the ones that consistently get ranked in the higher quartile, where the quality is absolutely high, and if these companies are witnessing a lot of positive momentum, then we create a basket of that, and that is called the quality small cap smart beta. So the minimum investment amount for this small case is slightly on the lower side. This is 21,000 rupees. And some of the special characteristics are it is exclusively small cap focused. It is always going to consist of small cap companies. It gives you exposure. I already told you what is factor investing. So it gives you exposure to one, the size premium, which is investing in small cap stocks. Second, the quality premium, because we are not just picking up small cap stocks. We are picking up small cap stocks that have consistently ranked high on the quality scale. And then these stocks should also be witnessing price momentum, right? So these are the three factors that you get access to. And the small case has been live since December 2020. So we have about 3 years of past performance that you can take a look at before jumping into the small case. Now, two things that I would like to highlight. How has the small case performed during extreme market situations, both uptrends and downtrends? Now, since since the small case went live only in December 2020, there are three circumstances under which we can check it out. First, during the Russia-Ukraine crisis, which is Feb 2020 to March 2023, that I just showed you, small cap smart beta was down just 2.1%, whereas the equity small cap universe was down 18%. During post-COVID pickup, the small cap smart beta jumped up by 91%, whereas equity small cap universe jumped up only by 78%. And during the recent India growth story, the small cap stocks has been up 50%, whereas the equity small cap stocks have done slightly better at 68%. But we are still, this is a developing story. So we are confident that, going forward, this small cap, the performance of the quality small cap smart beta will pick up, and reach the performance of equity small cap stocks. And one other factor that I would like to draw your attention to is the max drawdown. Now, what is a max drawdown? It refers to the lowest point in terms of performance, how far it can fall down when compared to a comparable universe. So max drawdown for quality small cap smart beta is negative 22.6%. So if you had invested 100 rupees, the value of the portfolio could have dropped down till about 77, 78 rupees. If you compare that with that of the equity small cap universe for the same time period, the max drawdown for equity small cap is negative 33.4%. So that is one another factor. Now, the next small case is the value and momentum small case. This small case, very self-explanatory. It consists of stocks that have been that are lower value, which means they have low PE ratio when compared to the rest of the universe, and they are high on the momentum scale. The minimum investment amount is slightly on the higher side. It is about 80,000 rupees. It's a market cap agnostic basket. So what happens is, since we are looking for specifically for low PE stocks that have started witnessing momentum, a lot of mid and small cap stocks tend to get self-selected into the basket. Unlike the quality small cap smart beta small case, where we are looking specifically for small cap stocks, here we are not looking specifically for small cap stocks. But because of the way the criteria has been set up, the small case tends to be mid and small cap heavy. And this has been one of our top performing small cases over the last 1 year. It's been live since April 2016. So we have a lot of performance. We have extremely good understanding of how these factors have worked across different market conditions. It's not just our top performing over the last 1 year. It's generally been one of our best performing small cases and consistent performing small cases ever since we've launched small cases. Max drawdown of the small case is 60.4% and versus 65.1% of the equity small cap stocks. So the numbers are different. The number for equity small cap universe is different when compared to the previous slide because we have a longer history of comparing it. There is a lot more data available. So as far as performance during crisis and non-crisis period is concerned, COVID-19 value and momentum was flat. Equity small cap down 22%. Russia-Ukraine crisis value and momentum flat. Return 3%. Equity small cap stocks were down 17.9%. Performance during post-COVID pickup matched the performance of equity small cap stocks. So this is one, and India growth story. Small cap has been up 62% since March 2023 versus 68 for equity small cap stock. So one thing that you should sort of notice over here is the max drawdowns are lower for value and momentum small case, right? So when equity small cap stocks tend to do poorly and they start dropping down, the value and momentum stocks will not follow them. They will sort of flatline. And when there is recovery, the value and momentum small case is able to match the recovery of equity small cap stocks, which is why you have slightly less volatility when compared to the universe of equity small cap stocks. Not just that, your performance recovery is significantly higher than that of equity small cap stocks because it does not drop down as much, right? That's a very important factor to consider. Next, we have the dividend star small case. So the dividend star small case, here we are looking at companies which have a track record of consistently paying out dividends. That is the first thing. There has to be consistency in paying out dividends. Then there should not have been any cut in dividend payments, right? So that's the second most important factor. Third, the average dividend yield should be at least 2% for these companies. So 2% of your stock returns or whatever returns should just come in via the dividend yield aspect of it, right? So the minimum investment amount for this small case is about 64,500. Once again, since we are looking at companies that have a consistent history of paying dividends, not cutting dividends, as well as dividend yields being on the lower side, there is a lot of small cap stocks that tend to come into the basket. That there is self-selection of small cap stocks. Now, there are a few large cap stocks also coming, usually from the PSU side, because they have a consistent history of paying out dividends and they tend to be on the slightly undervalued side as far as dividend yields are concerned. But largely, it is a small cap heavy basket. This small case has also been live since April 2016. And the max drawdown for this small case is negative 47% versus 65% for equity small cap universe. Now, once again, notice the difference in drawdown between value and momentum small case versus the dividend star small case. The drawdown is significantly lower because these stocks tend to pay dividends, right? So markets tend to have a special affinity or they tend to like these companies which pay dividends, and that is witnessed in the drawdown, right? When there is a meltdown, the companies which have a consistent history of paying dividends don't melt down as much. Now, performance during extreme situations, as can be seen, COVID-19 crisis, dividend stars, 1.7% positive returns, equity small cap down 22%. Russia-Ukraine crisis, flattish performance, equity small cap down 17%. Performance during post-COVID pickup, obviously dividend stars underperformed equity small cap, but then remember, it had not fallen during the previous crisis, right? Very similarly, India growth story, dividend stars has underperformed, but then it did not fall during the previous crisis. And on top of that, you could sort of understand that about 2% more returns are going to come in because of the dividend aspect of it. So there is a consistent cash flow coming in via dividend. On top of that, there is stable capital appreciation that is happening because of taking exposure to small cap stocks. So one has to look at it that way when investing in dividend star small case. Now the last one from our basket is Cancelimisk. The Cancelimisk small case consists of growing companies. Value and momentum was value companies mostly. So here we have growing companies that have been experiencing positive momentum. So the minimum investment amount of the small case is about 62,000 rupees. And once again, like our other like value and momentum and dividend stars, because of the way the criteria has been set up in terms of growing companies as well as experiencing positive momentum, a lot of small cap stocks tend to get auto selected into this small case. And the factors that you get exposure to are growth, quality, and momentum. And this small case has also been live since March 2017. So we have a fair amount of history available. Once again, max drawdown is on the lower side, just 40% drawdown versus 65% of equity small cap universe. And then during extreme performance also, the performance has been better. Once again, COVID-19 crisis, flattish performance, Russia-Ukraine crisis, flattish performance versus that of equity small cap. Performance during post-COVID pickup, not as much as equity small cap, but significant performance, right? So it's not falling down and it's picking up easily. So these are the four small cap stocks that I wanted to discuss with you. In conclusion, so if we have to sort of summarize our entire discussion, if you look at today's universe, there are more 800 small cap companies with market capitalization greater than 1,000 crore. The reason why I'm saying market capitalization of greater than 1,000 crore is because there is some amount of information available for these stocks, historical financials and all of these things. If you tend to start going below 1,000 crore, mark, the information availability becomes very, very difficult. So you have at least 800 small cap companies between up to 1,000 crore. And then these companies tend to have significant potential for growth, which means there is a significant potential for price appreciation also going forward. So if you are interested in investing these stocks, there is a lot of opportunity that you can seize on with an emerging company, right? Instead of going in for a large cap stocks which has already run up, whose performance is sort of very, very visible, if you decide to take a little more a risk and sort of you're interested in seizing that opportunity, the potential for growth is very, very high. But the downside to investing in such companies is there might be a lot of stagnancies, there can be a lot of volatility and all of these things as well. So investing in small cap stocks, obviously there is a lot of risk, and there is, if you attempt to do it on your own, there is a good possibility that you will end up losing money because the business sort of went kaput and a lot of bad things happened to the stocks that you've invested in. So one way to look to investing in such small cap companies is via curated portfolios. Now, I'm not recommending that you should go ahead and invest only in Windmill Capital small cases, but the performance is in front of you. I have talked about the performance. You guys already know about sort of the do-it-yourself approach and sort of the support that is available to you as far as Windmill Capital small cases are concerned. So overall, the suggestion is if you are considering investing in small cap stocks, then better go via any curated portfolio, whether it is Windmill Capital or some other curated portfolio that's available in the market. At least as far as Windmill is concerned, I think there is a regular rebalancing that's available. A lot of information is available to you, and you obviously there is a lot of support that's available to you via email or through AMAs and stuff like that, right? So overall, that's the discussion that I wanted to have with you regarding small cap stocks and investing in Windmill Capital's small cap specific small cases. Right now, the next idea that I wanted to discuss with you was some amount of rebalance related discussions. The first one is rebalancing modern small cases. So we've pretty much rebalanced all of our paid small cases. Value and momentum, there's been fair amount of churn this time. Cancel risk also, there's been fair amount of churn. Growth at fair price, lot of churn. Dividend smart beta, not so much. Straight flush also, a lot of churn. Low risk smart beta, not so much. So there's the logic behind model small cases is if they meet the model criteria, we are going to keep it in the basket. If they don't meet the model criteria, we will move it out of the basket. That's what there is to it. So I'm not going to dig deep into it. The only other change that we made this time as far as thematic small cases are concerned is we've dropped Dabur from our brand value small case. So the couple of reasons which we felt was affecting performance of Dabur since the last couple of quarters, and I'll quickly read through them. One is on the healthcare side. I think whatever was the COVID-led tailwinds, Dabur with its Chyawanprash and honey and all of these things, they have not been able to capitalize on that growth in that particular market. There's been a lot of competition in that market, and Dabur has not really benefited because of that tailwind is one aspect. Second aspect is their foray into oral care, right? They forayed into oral care along with Patanjali and all of other things, and they were taking on bigger players like Colgate. So this oral care segment has seen significant slowdown since FY 2023. And because of all the competition and stuff like that, and because of the slowdown, they have had to downgrade to lower sort of like, unit pricing also, which was one other factor that sort of like, solidified our theory. Next, their presence in hair care vertical has been quite challenging because the overall vertical itself is very sort of discretionary in nature, and because of all the slowdowns and increase in raw material costs and stuff like that. It is not just Dabur's hair care vertical. Pretty much everybody has Bajaj and Marico. All of these people have sort of like started seeing slowdown, which is affecting their overall performance. Their home and skincare category also this time did not do well. One, there's been intense competition. Second, there's been a lot of erratic weather conditions, because of which a lot of companies sort of like suffered. International business has been facing a lot of geopolitical challenges. The geographies that they are in, there's not a lot of dollar availability, which means exports are going to suffer from Dabur. There's been like sort of like a downtrend in demand also there. Geopolitical challenges in the Middle East are another thing. And lastly, rural market. I think rural market contributes 40 to 50% of the total sales. The demand environment has been fairly muted in the rural market because of unfavorable seasonal rains and all of these things. There's been delayed rainfall in large parts of rural India also this time. So that has affected, rural. That is another factor sort of contributing to the performance of rural demand. And because margin pressures have gone down, there are a lot of local regional players that have started entering the market again. So which means competitive conditions are going to increase. So all these factors sort of came together for us, and which is why we thought like, it is best to sort of drop this company from the basket for now. Obviously, we'll continue to track this company, and if we feel where like the performance has started improving because of improvement in underlying conditions, we will definitely get back to this. So that is as far as rebalancing is concerned. I think that sort of brings me to the end of my discussion. Now let's quickly jump on to a couple of questions. This time I hope to spend quite some time with the question and answer session, because usually we have a lot more questions than we can actually answer. Okay, so first one, I think Shivendra is asking me, how long will the small cap rally continue? Well, see, no manager can sort of predict how long it will continue. I can give you some number. I can say, depending on elections and depending on sort of like the 6.5% or 6.6% growth that everybody is talking about, and all of these things, it is going to continue for some time. But how long, nobody can predict. Naveen Rao has said, I had chosen Naked Trader when it is paid subscription. Now it is free. Does it mean that it is not given priority? Should I sell? I don't think Naked Trader has ever been part of the paid subscription plan. Since we launched the subscription plan in August 2021, there have been 15 small cases as part of the paid plan, and those 15 small cases have stayed, right? So I'm not sure why you're saying it's a paid subscription. And if something is paid, we will never go back and make it free. It does not make business sense for us. And regarding the most important question of whether it is not given priority, we give equal priority to all our small cases, whether it is a free small case or a paid small case. It might be hard to believe for some people, but we spend the same amount of time and effort into sort of maintaining these small cases, rebalancing them, tracking their performance, and all of these things. So, and in my understanding, Naked Trader has done an absolutely fantastic job in terms of returns and stuff like that. So I'm not going to recommend to you whether you should buy it or sell it. But if the underlying condition, if the underlying understanding is something like, Windmill Capital is not going to pay a lot of attention to it, that's not the case. That is all I can tell you. Ram, what should be capital for good gain for CanSlim and quality small cap? Ram, I think I told you with regard when I was talking about core and satellite portfolios, I was telling you what should be the allocation to a CanSlim or a quality small cap smart beta depends on your individual condition, depends on your ability to take risk, how much amount of money you are ready to invest in each month, what is your age profile, and all of these factors. So it has to be a customized answer. It's not possible for me to sort of like just quote some amount of money. I suggest you please reach out to an investment advisor to get a better understanding of how much risk you will be able to take, how much risk you should take, and then depending on the answer, decide how much amount of money you should dedicate to investing in CanSlim or any other Windmill Capital small case. Also mention on your apps 1 year and 2 year performance of small caps beside 3 years and since inception. See, what happens on the app is there are certain design limitations in terms of customized performance that we can show. But on the app as well as on the website, you can download. If you look at the chart, there is a download chart section, right? You can download the index series of the small case from over there. The comparable index data is also available to you. You can just do the calculation by yourself. Okay. Ram is saying quality small cap is having monthly churning, causing lots of fees and charges on a monthly basis. So it should be addressed for minimum invested amount. Yes, because it is a monthly small case. Of course, there is a lot of churn, but I'm not sure what it means when you say it should be addressed for minimum invested amount. I'm not too sure about that. Just probably clarify it a little better for me. Nirmal Pandey is saying, I'm invested in value and momentum small case. Wanted to ask if this small case will always be small cap heavy or it changes according to market situations. Nirmal, good question, actually. See, like I told you, with value and momentum, we are not attempting to make it a small cap specific stock case, a small case, right? The way the criteria has been set up for this particular small case, there is a lot of self-selection of small cap stocks. And this is a trend that we've been seeing right from the beginning, which is since April 2016. This is a trend that we've been witnessing. So there might be extreme market conditions under which it will not be a small cap heavy basket, but I am yet to witness such conditions in the last 6 or 7 years that I've been tracking this particular small case. So I hope that answers your question. Ultimately United, I invested in Safe Haven. Is it good for long-term investment or not? Well, any small case that we are offering is good for long-term investment. I don't think there is any, if a small case was not good for long-term investment, we would not have added it in the basket or we would not have made it live. There are specific small cases, for instance, like specialty chemicals, because our sector is going through a downturn, we have sort of blocked it. So there are instances like that also, which is why if it is live, it is good for long-term investment. Gauhar Fatima, good question. Why are there so many small case from Windmill Capital? Can't we have 3 to 4 small case only? We could have 3 to 4 small cases. Ultimately, I think depending on each investor, every investor will not want to invest in every small case. But our idea as a company, our strategy as a company is to appeal to everybody, right? Somebody is invested in, low churn portfolios like AWI or top 100 stocks, which can be part of your core portfolio. Somebody else wants to invest in fast moving satellites like value and momentum or CanSlimISC. Somebody else might be invested in a slightly slow moving satellite. Somebody else might want exposure to sector specific small cases. So our attempt is to make ourselves available or make sure that we have offerings that cater to everybody, right? So my suggestion is, whether you're using the app, Gauhar, whether you're using the app or whether you're using the smallcase.com platform, just use the discover option right at the top to check to see which sort of small case meets your criteria, and then you can dig down from there. If you have any questions about any of these small cases, you can reach out to us on support@windmill.capital. We will be more than happy to give you all additional details that you might need. Next, Vineet is saying, can you please give updates on growth at fair price? Is it actively being managed? Yes, if I think it got rebalanced on 1st of December, so I'm not too sure why. I hope you've got the rebalance notification. You should have gotten the rebalance notification. If something, all our small cases, if it is live on the platform, it means it is being actively managed. One easy way to look at it is look at the rebalance dates. Whenever we are rebalancing the small case, we the dates get changed now. You would have gotten, if you have invested in the small case, you would have gotten the rebalance notification. So that's one way to understand whether it is being actively managed or not, right? Do you advise to exit or continue investing in it? So for regulatory reasons, I'll not be able to give you any suggestions around whether you should invest in a particular small case or you should exit it or anything of that sort. And I'm not even sure what are the reasons why you want to say you want to exit. My suggestion is, if you want some more details, please write to us at support@windmill.capital. We might be able to give you some more details that will help you decide whether you want to stay invested or not. If there are no other details that you need, my suggestion is just reach out to an investment advisor and talk to him or her about the small case, and you can get a good suggestion on what you should be doing. Ravi Teja is saying, when we say long term, what is the minimum period we are expected to hold for? And is SIP a good option in small cases over mutual fund? Good question, Ravi Teja. When we say long term, what is the minimum period? When it comes to stocks, any long term is over and above 3 to 4 year time period, right? Within that, if it comes to small cap stocks, my minimum time period is at least 5 years, not less than that, right? Because I showed you what happens to downtrends and uptrends and stuff like that. You can see that, the longest downtrend that we saw was like close to 900 days during, which is like close to 3 year time period, which is what we saw during Greek debt crisis, if my memory serves me right? So there is a long period of time where the stock, where your stock performance might be trending down, or it might be very, very flattish. If you take into consideration time value of money, even a flattish performance means you have lost, value for the money that you have invested in. So going with the idea that it is going to be like, at least for 5 years, if it is a small cap stock, 5 to 7 year time period is good. And SIP is an absolutely fantastic option, whether you are investing in small cases or whether you're investing in mutual funds, right? It allows you to average out your gains or losses. That way, it brings about an investment discipline. Do not attempt to time the market. You will not be able to do that. So that's what there is to it. Next, we have Chetan Gupta is saying, question on electric mobility. It is suggesting a CAGR in the last 6 years of 22%, but when compared to benchmark indices, it is underperforming. Well, I don't have access to electric mobility performance right here. Let me see if I can pull it up. One aspect of electric mobility performance is it's been around since 2017, if my memory serves me right. And for long periods of time, when electric mobility had still not taken off in India, we were one of the first people to sort of recognize the trend and launch it. Which is why during the initial periods, it sort of it sort of underperformed the large cap index. But if you see from the last 2 years about, as and when electric mobility as an industry has been maturing, and we've been seeing a lot more electric vehicles, cars and trucks and everything, buses coming on the streets, the performance of the basket has actually picked up, and now it is sort of trying to meet the performance of equity large and mid cap stocks. So I hope that answers your question as to why it is 22% but still underperforming. We had a long period of underperformance. Now, as and when the industry has started picking up its performance, it's sort of it's sort of the performance has picked up, and now you can see that the performance is better for us. Next, we have Himanshu Mehta. Himanshu is saying, does Windmill offer small case which provide opportunities for bulk investments and which provide faster returns, having rebalance as per market and not as per like quarterly or half yearly? Well, Himanshu, this is a question that we keep getting asked again, I'll put money in bulk, my money should double and all of these things. Market does not cater to our whims and fancies. The returns get generated according to when the market decides it has to generate returns. To answer your question, no, we don't have any such specific small cases where if you put money in bulk, you will get greater returns. It never happens that way. Returns is a factor of growth, right? If you decide to put in, if the market return is 20%, if you decide to put in 1 crore, you will get 20 lakh returns on that. If you put in 100 rupees, you will get 20 rupees return on that, right? Your 20 lakh might be greater than 20 rupees, but it is still 20% of the amount of money that you have put in. That is how it works, right? And all small cases are rebalanced as per market conditions. This is something that I have talked about again and again and again and again, whether it is thematic small cases, whether it is model small cases or sectoral indices. For model small cases, we have determined via rigorous testing that quarterly rebalancing for most of the small cases works absolutely fine. There is no, reason to sort of go ahead and rebalance it over and over again. As far as thematic and other sectoral indices are concerned, there has to be some news for us to rebalance it, right? And when does the news get released? Once every quarter. So we take the quarterly news into consideration. We take all the news around the particular stock into consideration once every quarter, and we then decide whether we have to rebalance the small case or not. There might be extreme situations. I'll give you an example of that. An extreme situation of that is, bringing the blink small case, right? Recently, Delta Corp was part of bringing the blink small case. And then there was some negative news around tax demands and stuff like that. And we thought the tax demand was extremely high compared to the market cap of the company. And that's when we sort of dug deep into it. We thought the performance of the stock is going to get affected. And between two rebalance periods, we took a decision to drop it from the basket. We dropped it from the basket, and immediately it was communicated to all the investors of the small case. They got rebalance notifications and they were able to rebalance the small case successfully. So it is always need-based. Don't get stuck on this idea that just because a small case is getting rebalanced once every quarter or once every half-yearly period, it will not work. The performance that I just showed you, the performance for value and momentum, dividend, stars, and CanSlim, the performance is absolutely fantastic in spite of a quarterly rebalance, and they will continue to do well because we are backtesting, as well as the history of the small case suggests that quarterly rebalancing is more than sufficient to generate good amount of returns. The higher I rebalance, you might be very happy, but you will end up churning your basket a lot more, and it will not result in any proportionate, increase in returns. Okay. Then we have Gopiraj Shankar. Could you please share insight on SIP to small cases? I've asked the same question about some stocks. Rupee value is higher than others. Initial investment recommended amount is given up, but SIP is not. Gopiraj, my suggestion is I can send out some links to you. It will sort of if I have to start explaining this to you, it will become a little confusing. My suggestion is please drop in a line to support@windmill.capital. Our support ID is available on our website. You can take a look at that, but let me call it out to you again. It's support@windmill.capital. Please just drop in a line. I'll send you a lot of literature around SIP, around how SIP works in small cases. That should clarify all your doubts. I think that's pretty much in terms of the questions. I don't think we have many more. I'm just trying to pick up a few good ones. Just give me 1 second here. I think, yeah. I think most of it I have already answered. Again, how much minimum amount should we invest in paid small cases for decent returns, including fees? I think Gunjan Kumar is asking me that. Usually the expense ratio should be about 1%. Expense ratio, let me explain, is the amount of money that you're paying as either subscription fees or management fees divided by the total amount of money that you have actually invested in the small case. It should be about 1%, right? So the minimum investment amount for value and momentum is about 80,000 rupees, and you're paying 8,000 rupees as the subscription fees. So my suggestion is, over a period of time, try to take it up to a situation where the amount comes down to 1 to 2%, which means anywhere between 6 to 8 lakh rupees would be would be recommended. Of course, we don't suggest that you do it on day one. If you decide to start investing in the small case, attempt to scale it up to that level so that it makes sense for you in terms of the expense ratio. I think most of other stocks, Gunjan Kumar is again asking me, what's your view on small cap stocks? This is currently overvalued. I think that was what the entire presentation was about. If you joined in late, Gunjan, the recording of the presentation is going to be available for you on YouTube. I suggest you just take a look at it. Nishant Singh is asking me, do we have a small case which focus on EV sectors? Yes, there is an electric mobility small case. I explained to Chetan why it underperformed during the initial years and why the performance has picked up subsequently. So you can take a look at that. Electric mobility, that's the name. Just remember that. I think then questions like, what is your view on value and momentum for upcoming 10 years? I think it's going to be great. 7 years we've done very well. I don't see any reason why we should not do it for the other 7 years. I think there is one last question here. One last question. Somebody is asking me whether the subscription is for one small case or all small case in Windmill. Now, Thanks for asking me this question so that we can clarify it. Initially, we used to have a bundled subscription where if you paid 6,000 rupees, you would get access to all 15, paid small cases. But when we got a lot of feedback saying that, I don't want access to all of these small cases, you can please give me only specific small cases that I want to invest in, but reduce the small case fees and stuff like that. So since then, what we have done is we've unbundled our entire plan. Now you have to pay by each small case, or you need to pay only for those small cases that you invested in. If you go onto our Windmill Capital website, there is a lot of literature around what is the charge associated with each small cases. Some of them are slightly higher than 6,000 rupees, but a lot of them are we decided to price it lower, so it makes sense. It is a lot lower than 6,000 rupees also. So to summarize, it is for the prices that I quoted to you were for one single small case. You can take a look at that. There is a 3-month paying option as well as an yearly option. If you decide to invest, just drop in a line to support@windmill.capital and tell us that you want to invest in. If at that time we have access to any coupon code and stuff like that, we will definitely share that with you. So I think that sort of covers all the questions that we had for this presentation. Thanks so much for joining in. Have a great weekend. Thanks. Bye.